Hi, this is Leslie. Hope you're well. In this video, I'm going to tell you why I'm betting against the crowd on something. I'm actually betting against the herd on something very important. And also, guys, in this video, I'm going to answer a question many of you have been asking, which is that all the money printing that the Federal Reserve has been doing, isn't that going to cause severe hyperinflation in the next few years? You might be surprised when I tell you the answer. Join me. Alright guys, welcome back. Before we begin, let me just tell you where I am. These mountain regions behind me you see here, this is what's called, in fact the mountain behind me is called Ben Nevis because I'm in the Highlands of Scotland. In fact, I'm very close to a town called Glencoe and Fort William here in Scotland. And guys, it's just an amazing region. By the way, guys, did you know this? Did you know that a lot of people in England have never visited Scotland? It's true. So guys, I really think if you get a chance, really come over here. It's just a peaceful and amazing place to be in the Highlands of Scotland. All right, guys, let's talk about the markets. And in a few moments, I'm going to tell you why I'm betting against the crowd, betting against the herd on something that is quite important. I'm going to tell you why in a few moments. Before we do that though, let me just give you some context. You see guys, a few weeks ago, you may remember I posted a video and I explained why we're likely heading towards deflation, not inflation or hyperinflation. Now, you might be surprised by this, but again, if you haven't seen the video, I highly recommend go and watch it because it takes too long for me to explain it here. But essentially, in a nutshell, what I said in the video was the reason why we're heading towards deflation in the next few years, not inflation, is because of several important factors. One of the important reasons is that we're heading towards a likely depression, an economic depression in the next few years. Not just a recession, but actually an economic depression. And here's the thing, history has taught us that recessions and depressions are deflationary, not inflationary. So for example, the previous major recession that we had in 2008, notice there was a deflationary period. Inflation dropped massively. The same thing happened in the year 2000 in that major recession. So history has taught us that depressions, economic depressions, are likely to be deflationary, not inflationary. So as opposed to expecting rising prices in the next major economic depression, we are likely to see falling prices in the next major economic nightmare and crisis. But that's not all. Another reason why I think we're heading towards deflation in the next few years is because of the fact that bonds have likely bottomed. The fact that bond prices have likely bottomed and starting an uptrend, that is also a sign that the smart money is anticipating deflation in the next few years. Not right now. Again, remember, the economy is always lagging behind the market. So that's why market prices often lead the way before the economy sees a shift and a change. So that's another reason why I think we're heading towards deflation, not inflation. Now, I know what you might be thinking at this point. You're probably thinking, well, hang on a second, Alessio, that doesn't sound right. Because what about all the money printing that the Fed has been doing? What about all that QE, increasing the money supply? Surely that's going to cause inflation or hyperinflation in the next few years. Because it is true, the Federal Reserve has been doing QE, money printing, in the past decade. So surely that's going to cause inflation or hyperinflation in the next few years. So that would mean any threat of deflation is likely wrong, right? Well, actually, that's not quite right. Let me explain why. So is it possible that all the printing that the Federal Reserve has been doing is going to cause inflation or hyperinflation? Is it possible? Yes, anything is possible. The question is it likely? Is it probable? And my answer, you might be shocked by this, is no. And here's why. You see guys, printing money or increasing the money supply on its own is not enough to cause inflation or hyperinflation. You see, there's something else that you need for inflation, which is increase in the supply of credits. There are two things that inflation is linked to: the money supply and the supply of credits. And by the way, guys, for further reading on this issue, I highly recommend you read the book Conquering the Crash 2020 by Robert Prechter. So let me explain this point very briefly and simply. Firstly, as I'm sure you know, Japan has been printing money for the last several years. In fact, Japan started a major program of printing money, or QE, several years ago. In fact, they printed money to the tune of trillions of dollars. And after all that money printing, did Japan see any inflation? No. In fact, inflation has completely failed to spark in Japan, despite trillions of dollars of money being printed over there in that country. According to an article from the Wall Street Journal, the major threat facing Japan right now is not inflation, but deflation, as you can see here. And as you can see from this chart, Japan's inflation rate is still relatively low than where it was. Now, here's something else we need to talk about, which is that during a recession or an economic depression, what usually happens is that banks reduce and cut the supply of credit. Remember guys, for inflation to occur, you need an increase in the supply of credit. But actually what usually happens, as I'm sure you know, in a recession, what do banks do? Do banks like to lend money to people during a recession and depression when they know that people may default and not pay them back? No, in fact, what banks do during a recession and depression is that they reduce and cut the supply of credit. In other words, what banks usually do in a recession depression is that they reduce the ability of people to borrow. So for example, if you want to go to your bank to borrow money, for example, to invest in something or buy real estate or invest in a business or start a business, in a healthy and normal economy, sure, banks do lend you money for that kind of thing. But in a recession or a depression, the opposite happens. because banks are worried about not getting their money back during tough economic times when there is high unemployment and low GDP, in those kind of situations, what banks usually do is they reduce the supply of credit. They make it much more difficult for people to borrow in those kind of situations. And that kind of action causes deflation, causes falling prices, not rising prices. So a reduction in the supply of credit causes deflation, not inflation. That's why, guys, you may remember in the 2008 recession, we had what's called a credit crunch. Why was it called that? Because essentially, that's what they did. Banks reduced the ability of people to borrow to invest in things like real estate or start a business or things like that. And there is something else as well. Usually in a recession and an economic depression, money goes out of risky assets like stocks and real estate and goes into cash. Why? Because most people afraid of losing money, for example, if they fear losing money in their real estate or stock investments, they may sell those assets, and that means money goes into cash. It usually goes into the US dollar. So remember, guys, in an economic recession and depression, cash is usually king, and there's usually a rise in the price of the US dollar. So that's why, guys, as I explained in my previous video, I think the next major threat facing us is deflation in the next few years, not inflation. And that's why money printing or QE does not necessarily lead to inflation or hyperinflation. Again, Japan tried this and they failed massively. So this brings me to the next point here, which is the bet that I'm making, which is against the crowd. You see, guys, the majority of folks out there, the majority of people out there, they think that the US dollar is doomed. They think the US dollar is going to get trashed in the next few years. Why? Because they're expecting hyperinflation. In fact, all the media ever talks about right now is inflation and not deflation. So that's why the crowd, almost everybody out there, is expecting a crash in the US dollar, which is completely the opposite of what I'm expecting. In fact, I'm betting against the crowd on this point. I'm betting against the herd. While the herd is bearish on the US dollar, I'm actually bullish for the dollar. As long as the dollar remains above the June lows, the level you see here, I remain bullish on the dollar. And by the way, one important thing, the US dollar just recently broke out of a trend line. It broke above this trend line you see here, and that actually is a very bullish action. So as long as the US dollar remains above that trend line and the support lows of June, I continue to remain bullish on the dollar, and the same goes with bonds as well. Bonds have also established an uptrend and have likely bottomed, so as long as bonds remain above their June lows, I remain bullish on bonds as well. Now, in a future video, I'm going to answer a question many of you have been asking me, which is that what things could do badly in a deflationary nightmare and what things could do quite well. So I'll try to make a video for you about this, guys, and I'll answer that question for you in the next video updates. In the meantime, in the Highlands of Scotland near Fort William here, I want to wish you a fantastic week and a fantastic day. Have a great day, and bye for now.